I think at the end of the day, one myth when it comes to startups, if you define startups as an industry, it's something maybe that's more applicable to more founders, right? Is this idea that, all right, once you raise capital, it's just going to solve your problems. You're going to find product market fit. That is wrong because it's not the money that determines your ability to dig into what your users really want and how they're using your product. But very often founders think, especially the raise for the first time, like, okay, raising a bunch of money is just going to solve my problem. It's going to solve some problems. You'll probably also spend more money, right, once you raise money. And in some cases, it can be definitely helpful to have bigger budgets and definitely helpful to have a longer runway, but it's not equal to product market fit. It doesn't mean that, hey, this is really going to take off. So keep going at it, keep building, whether you raise capital or not. You can go out and you can build something great if you really just focus on creating a great product for your customers.
Awesome. Hey everyone, this is Devin Miller here with another episode of The Inventive Expert. I'm your host, Devin Miller, the serial entrepreneur that's grown several startups into 7- and 8-figure businesses, as well as founder and CEO of Miller IP Law, where we help startups and small businesses with their patents and trademarks. If you ever need help with yours, just go to strategymeeting.com, grab some time with us to chat. We're always here to help. Now, today we've got another great guest on the podcast, Rune Hauge. And Rune is going to talk about a lot of great topics, and are kicking off with seed fundraising, which is something a lot of startups and small businesses often go through, as well as how the economic climate may have shifted that and impacted it a bit. We'll also talk a little bit about the merits of VCs and the startup founders, what they should focus on as far as those merits, and maybe why or why not you might consider an accelerator, and probably a few other great topics. So excited for a great conversation. With that much, welcome on the podcast, Rune.
Thanks, Devin. It's great to be here.
Well, excited to have you. So before we dive into the topics at hand, just for those that as a reminder to the audience, Rune was also on the Inventive Journey podcast, which is a sister podcast of this one. So definitely go make sure to check that out. But in the meantime, for those that haven't had a chance to catch that episode or just want a quick intro to you, maybe take a minute or two and introduce yourself to the audience.
Yeah, absolutely, will do. So I'm Rune Hauge. I'm the founder and CEO of MentorCam. And MentorCam, for those of you who don't know, is a platform where founders and entrepreneurs can get access to advisors and experts for mentorship on topics relating to business growth and startups.
Awesome. Well, that's a great intro, and I'm sure it'll be a lot of great topics that will be informative and a great background for the topics at hand. So with that, maybe I'm going to skip to one of the second things, which is my guess is, as startups and small businesses are looking at the economic climate and the shift and everything else, it probably has people wondering is investing, seed fundraising, everything still going on, and how might recent developments with the inflation and or costs going up and some of the stock market and that, how is that has it impacted it, or how has it impacted it, and what should people be aware of?
Yeah, no, absolutely, it's a great question, and I think first of all, no one knows how long this downturn is going to last. It does look like we're heading into a little bit of a trough. However, I think very often it's during times like this when the best ideas thrive. So, in terms of fundraising, when I talk to VCs, I don't think early stage has dried up. However, I think later stage probably has slowed down a little bit. What seems to be the case is that because these public market multiples have gone down pretty dramatically. Stock market's dropping, right? And because of that, the multiples in private markets have sort of gone, changed as well, right? And what I mean by that is that the valuations that you typically saw a year ago, and maybe even a few months ago, you're not seeing anymore. Meaning that startup founders have to be prepared to raise at lower valuations, take more dilutions, or maybe even raise less capital. But I don't think things have dried up. I don't think LPs at venture capital firms have started clawing back money or anything like that. And there are funds that have dry powder to invest. So I still think it's possible. I just think the climate has changed a little bit and is changing. So people have to be a little bit sharper when they go out, and just be a little more prepared for those changes in valuations, and set expectations accordingly.
And so, and I think that certainly makes sense. Now, maybe just a follow-up question to that. When you say sharper, is that just, be even more polished in a presentation or your pitch, or there, have your business adjusted or have it farther along, or other things? Or what kind of, when you're looking, saying, in or sharper, what are some of those things people should be making sure to be sharp on?
Yeah, that's also a really good question. So I think investors will look at these opportunities more with a keen eye. There's less rush to get into a round. So what startup founders should be thinking about when raising, I think, is, first of all, do you have a sound business, right? Do you have traction? And making sure that when you go out and raise, that you're at a point where you can really show that you're making progress, and that you really have a big opportunity, right? Because these investors are going to dig in a little more. So make sure you have your ducks in a row in that regard. In some cases, it means maybe focusing more on the business, trying to stay lean and extending runway so you can get the business going before you go out and raise, right? Especially if you're doing a pre-seed or seed round, many times you don't have a ton of traction already, right? And I think now it's going to be more difficult to raise on just an idea or just very little early stage traction, just because investors are being a little more careful about how they or who they open their wallets to.
No, I think that that definitely makes sense. So now, maybe just now broadening it up, whether or not it's the economic climate we're in, or some of the things that have shifted, but even in general. So, if you're talking to someone that's is maybe a startup or a small business just getting going, and they are looking to do a seed raising, kind of what are the things that they should be considering in general, as far as how to prepare, how to go out, and how to actually do that raising round?
Yeah, no, I think the first thing to determine is if you're building a startup or a small business, because those things are inherently different, at least in the eyes of investors, right? A startup company, by definition, is a company that can scale fast and that grows, right? So if you have a company that can potentially be a billion-dollar company, that's what's really interesting to investors, right? Or to VCs, not necessarily all investors, but to VCs. If you have a small business, for example, if you're doing a brick and mortar store or an e-commerce company, or a mobile barber truck, I just walked by one, then that's probably not the type of business where you will raise venture capital and have to think about other sources of financing. You'll probably need less financing to create a sustainable business. Whereas if you're developing some kind of new technology, or you're a software company and you need a lot of capital to scale, right? To hire salespeople, to hire engineers, and then just to get the company up and going, right? And there's large but big potential. Then it's a startup company, right? And then you have to determine, okay, when should I go out and get capital from these investors? So usually what you want to do is think about, okay, who will open their wallets quickly, and who have appetite to take risk, perhaps at a lower valuation early on, and very often those aren't VCs, and they're angel investors, family offices, etc. Right, and then the big question is how to get in front of them. And then, but once you've raised a little bit of capital, once you start having a little bit of traction, then you might want to start thinking about raising from venture capitalists.
No, and I think that makes sense. And now maybe just one follow-up question to that, which is, so first of all, maybe as for the audience, before I get to the main questions, can ask, if you're looking at someone that's maybe a little bit less familiar, has a great idea, maybe has got started developing research and development or something, but haven't gone on doing a raise. Just for the audience, for clarity, what's the difference between an angel versus a VC or venture capital?
Yeah, absolutely. So an angel investor is an individual that invests his or her own money, right? So in many cases, this is perhaps a successful founder in your space, right? So if you're doing a video technology company, then there are probably a bunch of people, not only founders but also early employees of Zoom, who had a pretty good exit when Zoom went public, right? And might be interested in investing in other video companies because they can lend their expertise. Like angel investors often like to be involved a little bit, or at least early on, right? So finding these individuals that can lend their expertise and have the capital to invest in. There are many ways to find them, but we can talk about it later. And then VCs, these are funds, right? They're not investing their own money. This is their job to invest in private markets, in private not public held companies, right? Startups, identify these startups and put money from their fund into this. And these VCs, they also go out and they raise capital themselves for their funds from what are called limited partners, right? So LPs, if I used that term earlier, LPs, these are people that put money into the venture fund and make that available for the venture fund to invest. So essentially, that's the difference. Shorter way of saying is an angel is an individual, a VC is an investment professional that manages a fund where they're investing from.
Makes sense. And you hit on the question I was going to follow up with, which is, okay, so now we have that distinguishment between the two, which is a great explanation. As far as going out and finding them, how do you go about finding those VCs or those angels? And because I think that's a lot of times people say, okay, I need to go out and find them, or I need to go raise some money, and that's usually the genesis, right? I got a great idea, I got a business, maybe I need to grow it, maybe I need some money for research and development, maybe I do it, and sometimes you'll go to friends and family and you'll start to do that as a bit of a raise to get some initial investment to get things going. But once you get beyond kind of the friends and family going and asking them, then people sometimes will hit a wall of, well, I don't really know any investors, I don't really know anybody in that community or in that realm, and so they get kind of stuck or aren't quite sure. And so if you're in that situation, how do you go about kind of finding them or identifying them or otherwise determining who to go after or who to go after as far as for a raise?
So this is very common amongst first-time founders or founders raising capital for the first time, right? Like, where do I even get started? How do I do this? Right, and there's no official playbook. It's very difficult to Google your way to this, but there is some method to the madness. And step one is usually doing a lot of research. So your target investors, you want to have some criteria for who they are, right? And then you want to start building a list. So criteria can be, if you're an early stage company, you haven't raised before, right? You want to look at investors that invest at that stage. Right, and then you also want to try to find investors that invest in your industry. So, for example, Crunchbase is a good resource for this because then you can look up companies that recently raised and can see you invested in them. So you can try to find other startup companies that have raised. They shouldn't be a competitor because investors typically don't invest in competitive businesses, but in the same space, right? And at the same stage, or at least you look at who they raised from when they were at the stage that you're currently at, right? And then you start making a list. And this is especially true for when you get to the point where you're raising from VCs, but you can find angel investors as well. If you look at who did someone's like MentorCam's pre-seed round is probably the only one you can find because they haven't announced our seed round. You'll probably find some individual names there, if I'm not mistaken, in Crunchbase, right? And with a bunch of other startups as well. So start making that list, and then for the angels, you put their names in, right? And ideally, maybe a LinkedIn profile, keep a spreadsheet, or you can also use a CRM. I use a spreadsheet when I did this before, and if you use a VC, you also want to identify the partner that invests at your stage, right? So you can look at their website, you can look them up on Crunchbase, of course, but you also want to look on their website. You want to find out a little bit about their partners, and pretty quickly you'll find out who is investing in, for example, consumer technology or B2B at this particular fund, right? Or which fund is relevant for your space. And then once you've listed these names out, let's say maybe you start with a list of 30, I'll probably expand, then you want to find people that can introduce you to these investors, right? Because if you email them cold, chances are they're just going to ignore you. And even if they don't, so some might take a call, but still they don't really know who you are, right? They have no reference points. So in many cases, it's going to be very difficult to get them to write you a check. So you want to get some kind of introduction. And a lot of founders have gone through this. So if you find founders that they have invested in, it doesn't hurt to hit them up cold and ask for an introduction, right? And this is the kind of stuff that we also help with on a lot of our mentors help with on MentorCam, right? Training founders to go through this process. And there are other elements to this as well, but this is basically how you get started. You start doing a lot of research, and this is how you raise money from, essentially from strangers, right? And you'll find that this is what's so great about the startup ecosystem, and I guess the investors that are in it, that many of them are very, very keen on opening their wallets to essentially strangers, right? Sounds kind of odd, but that's essentially what they're doing, right?
Yeah.
So that's basically step one. Do a lot of research, create a list of targets, and find the people that can introduce you to these investors.
So now you say, okay, you find those, and now I'm going to shift gears just a bit. And I think that was a great answer. And I think it gives people a place to start. I do like the idea of, whether it's Crunchbase or others, that you're going to go out and look and see, not that, to your point, not competitors, because if they've already invested in a competitor, they're probably not likely to invest in you. And even if they may have a conflict, but otherwise, find somebody in your industry that is doing something at least in the same realm and that they may have invested in. It gives a good indication of, who might be of interest or be investing in those type of or products or industries. Now, shifting gears just a bit, one of the other things we talked about or touched on a little bit before the podcast was the idea of an accelerator. And, first of all, I think that there is good accelerator. I'll caveat with, I think there's some great accelerators out there. And I think there's some that are kind of the snake oil salesmen that take advantage of people. So one is, how do you find a good accelerator that is going to benefit, do it just like what it sounds of, accelerating your business and making it better? And then two, how do you decide whether or not an accelerator is right for you? Because I don't know that it's right in every circumstance and everybody needs to go through accelerator, and yet there are also people that can benefit. So kind of both on, how do you determine, I guess I'll flip the question, how do you determine if you need an accelerator, and then how do you identify a good one?
Yeah, absolutely. I think whether you're an experienced or inexperienced founder, there are cases where an accelerator can be very helpful, but there are a lot of different accelerators out there. There are only a few that are likely to be helpful in terms of raising capital, right? So the typical accelerator model is that they invest a small amount of money, or sometimes a slightly bigger amount of money. Y Combinator recently announced that they did a new deal earlier this year where they invest, I think it's 500,000. Up from 125, you usually, if you haven't raised capital before, right, it's your first rodeo, first time you're starting a company, then it doesn't hurt to apply at least to the top accelerator, and many of them are very difficult to get into, right? But you're putting yourself in a position of essentially maximizing your probable outcome, at least if you apply, right? But I think more experienced founders too do Accelerator, especially Y Combinator. We did Y Combinator, and they're maybe I'm biased here, but I think I can be so bold as to say that they are the #1 accelerator in the world for startups. So just that brand name alone will help you in your conversations with investors, and will help you attract investors, right? And you'll also meet a lot of other great founders to have in your network, and also the partners at YC as well. I can't really speak to the other accelerators. There's so many out there because I haven't gone through it, but Y Combinator definitely was a very valuable experience for us. And usually try to look at some of these alumni companies gone through if you're looking at other accelerators, and see, like, did they end up raising any capital, right? Because going through an accelerator and then not raising capital, I don't know if that's super helpful. For me, at least, like, the #1 thing about a startup accelerator is that you'll definitely get a boost in terms of raising capital and getting attraction from or being attracted to an investor if you pick the right one, right? And then, beyond that, if you never started a company before, there's also general startup advice that they typically provide.
No, I think that definitely is some great insight and answer. Now, maybe to ask one question, follow-up question, maybe narrowing it or honing it into you guys a little bit specifically, is when you got, with your business and with your background in that, how did you guys decide to go to the accelerator, go to Y Combinator and apply to that? What was the kind of the prompting and the motivation there?
Yeah, so I think our story was maybe a little bit unconventional, because we decided that we tried racing on our own. Right? We had actually unsuccessfully applied to Y Combinator once before, and decided, hey, we're just, that shouldn't be a deterrent. We're going to go and try and raise capital on our own, and we did. And then one of our early investors, who was a Y Combinator alum, said, as we're doing this race, maybe as a fallback option, you should apply for early admission to the next batch. And we did, and this time we did get in. The only difference was now we had raised $1 million, and we were at the cusp of raising $1.5 million, and our big blue chip investor that came in early actually signed the same day that we got accepted to Y Combinator. So in our case, even though we had raised $1.5 million, we decided to do Y Combinator still, and I'm glad we did. In our case, it really helped. It really gave us, I think, leverage in terms of fundraising, and also access to a phenomenal network. But I do think that, whether you do an accelerator or not, don't let the accelerator be the end goal, right? If you decide that you're going to build something great, then start building it. And if you decide to go out and race, okay, accelerator is one route, but decide that you're going to go through a process and do it thoroughly. And if you get into something like Y Combinator, great. If not, it's not the end of the world either.
No, I think that's a lot of great insight, and it's interesting. This was kind of interesting to hear kind of how you guys got into Y Combinator, and I also think highlighting you didn't get in the first time, and it was upon second application, and after you'd already gone out and tried to do it on your own, that maybe that progression or just the timing worked out and made it better. And so I think that's also definitely a great insight. So
yeah.
Well, now as we start to wrap up towards the end of the podcast, and we didn't even hit on half the topics, and it's always a fun area, because I think it's a lot of businesses go through. Not all, some people bootstrap it, or they otherwise don't need fundraising, or they can be profitable early on and reinvest. But I think for a lot of people, it's a lot of great insights. But now as we do wrap towards the end of the podcast, I do always have one question I ask at the end, and so we'll jump to that now, which is, within your industry, what's the biggest myth and why is it wrong?
Yeah, so I think at the end of the day, one myth when it comes to startups, if you define startups as an industry, it's something maybe that's more applicable to more founders, right? Is this idea that all right, once you raise capital, it's just going to solve your problems. You're going to find product market fit. That is wrong because it's not the money that determines your ability to dig into what your users really want and how they're using your product. But very often founders think, especially the race for the first time, like, okay, raising a bunch of money is just going to solve my problem. It's going to solve some problems. You'll probably also spend more money, right, once you raise money. And in some cases, it can be definitely helpful to have bigger budgets and definitely helpful to have a longer runway, but it's not equal to product market fit. It doesn't mean that, hey, this is really gonna take off. So keep going at it, keep building. Whether you raise capital or not, you can go out and you can build something great. If you really just focus on creating a great product for your customers.
Awesome. No, I think that's definitely a great takeaway and a good myth to dispel. So thank you for that. Well, now as we wrap up the podcast, if people want to reach out to you, they want to be a customer, they want to be a client, they want to be an employee, they want to be an investor, if you're taking on investors, they want to be your next best friend, any or all of the above, what's the best way to reach out to you, contact you, find out more?
Yeah, I'm on MentorCam as a mentor myself. So if you want some fundraising advice or you're interested inputs on just startups in general, you can hit me up on mentor.cam. However, we also do mentor matching. If you just want to ask me some questions in general or just get in touch, you can also email me. It's RUNE at mentor.cam, CAM. So shoot me an email or hit me up on mentor.cam if you want to get in touch.
Awesome. I definitely encourage people to reach out to connect and leverage a great resource. And well, with that, as we wrap up with the podcast, thank you again for coming on. It's been fun. It's been a pleasure. Now, for all of you listeners that are out there, if you can help us to make sure that everyone finds out about all these great expertise that are being shared, leave us a review, click share, click subscribe, and make sure that everybody else can find out about all this great expertise and help them along the journey. And on that note, if you ever need help with patents, trademarks, or anything else with your startup or small business, feel free to reach out to us at Miller IP Law. Just go to strategymeeting.com and we're always here to help. Thank you again, Rune, for coming on, and wish the next leg of your journey even better than the last.
Thanks for having me, Devin. I think at the end of the day, one myth when it comes to startups, if you define startups as an industry, it's something maybe that's more applicable to more founders, right? Is this idea that, all right, once you raise capital, it's just going to solve your problems. You're going to find product market fit. That is wrong, because it's not the money that determines your ability to dig into what your users really want and how they're using your product. But very often founders think, especially the raise for the first time, like, okay, raising a bunch of money is just going to solve my problem. It's going to solve some problems. You'll probably also spend more money, right, once you raise money, and in some cases, it can be definitely helpful to have bigger budgets, and definitely helpful to have a longer runway. But it's not equal to product market fit. It doesn't mean that, hey, this is really gonna take off. So keep going at it, keep building, whether you raise capital or not. You can go out and you can build something great if you really just focus on creating a great product for your customers.